So you want to start investing, or maybe you already have started, but you don't really feel like you know what you're doing or if you're doing it right. In today's video, we're giving you the full explanation of how to dive in with investing for the first time and give you an actual explanation of each step in the process. So by the end of this one video, you'll know exactly what you need to do first to really dive into it and be ready to jump into. Now, here's the thing. A lot of the time when you hear people talking about investments,
not all stocks bottom at the same time.
You know, I own Apple, Amazon.
Like, I don't know anything.
The bull is dead!
and maybe it's even what's enticing you to want to jump in and start investing yourself. They're talking a lot about single stocks, like maybe a classic big company example like Apple, or it could be more like, wow, this cheap little stock is killing it right now. You gotta jump in quick. That's making you feel that kind of sense of panic and urgency. Or it could be people talking about crypto, NFTs, and other great investment opportunities. Now that type of investing is fine and that's an option too, but there are also proven ways to make a great return, and that's consistently investing for the long term. Now, ideally, if you're able to put pretty passively money aside every single month, or at least on a consistent basis for decades, you're gonna set yourself up to be in a great position in the future. Now, if after all that's set up and you are interested in doing that other type of investing too, you can, but you are really gonna see by the end of this video why time in the market is a great thing, and it's something you're gonna wanna look into. So let's jump into it.
All right, so first things first, we have to touch on the fact that you have to be investing. So you have to have your money working for you. Now, what I think is interesting about, life for a lot of us, right, is that we're all kind of taught the same exact plan. Go to school, work really hard, and then get a job that pays you a whole bunch of money, right? And then once you're in that job, work really hard again, continue to work hard and get those salary increases and get those promotions. And then once you have that, if you continue working really hard, just maybe you'll be able to retire. And what I think is really interesting about that is the fact that, even if you were to save your salary, a good portion of your salary every single year, moving forward as you're going towards retirement, you still won't have that much money because your savings aren't earning you that much interest, right? Now, the exception to this, there is an exception, is your emergency fund. So that means having 6 months of readily available cash that you can access at any time if there's an emergency or just, any short-term things that come up. You have that money aside to actually access it. So let's just take a look at one of those classic examples here for a second. So let's say you put aside $1,000 a month for 30 years at a 2% annual interest rate. So once again, given the times that we're in right now, this would definitely be on the higher end of like a high interest savings account at one of the banks. But if you were to do that for 30 years, at the end of it, you would have just under $500,000. Now, if we flip the script and we go the investing route, if you started off with $0 and you invested $1,000 a month for 30 years at an 8% annual return, and once again, this seems like a pretty fair number given how the market has performed historically, if you were to do that for 30 years, you would have just under $1.5 million. That's almost $1 million more just for investing your money as opposed to letting it sit there. Now, after hearing those examples, if you're still thinking to yourself, investing is not for me, it's not safe, I don't want anything to do with it, remember, it can be, right? But historically, there's been a bunch of different investment options that have come about that are low risk, that are more passive, and often those investments perform a lot better. Now, it might not feel that way, especially when you're hearing all these different sound bites of different people, you're listening to your coworkers, but trust me, just because someone is more hands-on with their investments, that doesn't mean that that their investments are going to perform better than your investments. And what's interesting is that there's been a whole bunch of studies that have been done on this, where a recent one found that over a 20-year period, 90% of index funds perform better than active investments. Now, in general, active investments are run by people who are trying to beat the market. Simple as that. On the other hand, passive investments are simply trying to follow or match what the market's doing, not trying to beat it.
Okay, so passive investments do better than active ones in the long term. And that's good news for you because it means that it's less work actually choosing your investments and staying on top of everything. But let's take a look at what active investing would look like. One example is paying a financial advisor, like at a bank, to invest in something like mutual funds for you. So if you want to picture what mutual funds are, think of like a basket that can hold stocks, bonds, and other investments inside of it. Now, in this case, the actual fund manager who's running that mutual fund, they are doing the selecting of what goes into it for you, and they're specifically trying to beat the market for you. Now, because of that, because it's a real person, and that's the key here, this fund manager, that's the active piece, they're physically doing it themselves, you also have to pay for their efforts. And that's typically more expensive than other options out there, specifically when it comes to management fees for them to manage that fund for you. Now, is this worth it? Is it worth having someone try to actively beat the market for you and do all this work on your behalf? In our opinion, because there are so many different low-cost options out there that are more passive and typically perform better anyways, it's not the preferred route for us. Another type of active investing is selecting a single stocks yourself. Now, this one sounds pretty exciting. A lot of people think of investing in this way, so we definitely have to cover it. Now, a stock is literally a little piece of ownership in a company. So if you bought one stock of Apple, it means you own a tiny little fraction of the Apple company. So if the company's doing well, if it's making money, things are running smoothly, that's a good thing for you too. It means the value of your stock is higher and you're getting a higher return. Now, keep in mind that this method is definitely still a super active investing because you're hands-on. You're deciding which stocks you're investing in, how frequently you want to buy them, how many you want to buy. You're kind of having to think about your risk level and diversification across different industries, right? Like Apple is in the tech industry. And obviously there's more risk involved in that method too. Now, if you're interested in this type of investing, you can do it. A lot of people invest in this way. But remember that passive investments still perform better in the long term than active investing for most people most of the time. So we really want you to have that good base set up first of investing, and we believe in passively investing for the long term first, and then if you want to, adding on other types of investing too. So that's the high level on active investments, but now it's time to take it back to passive investments, the ones that we're telling you are going to give you those highest returns in the long term. Now, like we already said before, and to reiterate, the main goal of passive investing is to match what the market's doing. But what does that mean? What does it mean when we say what the market is doing? Now, again, high level here, but there are a lot of different market indexes out there. The ones that you might have heard of before are like the S&P 500. What that is an index of the 500 largest US companies. There's also the NASDAQ. That one's full of a lot of US listed tech companies specifically. There's also the total US stock market. So every stock that's listed in the US too, that's that index. And there's tons of different global ones too. Now, you get to choose which market or which part of the market or multiple markets that you want to try and match. So let's bring it back to that basket example like we were talking about before with mutual funds. But this time when it comes to passive investing, instead that basket of investments, all those different investments are tracking one or more of the examples that I just gave before. And this time, instead of a person actually being paid to choose those investments for you, they're just simply tracking an index that already exists. And they're called index funds, which is obviously a pretty fitting name. Now, one other thing I want to touch on when it comes to these index funds is the performance piece too. So let's take a look at the S&P 500, for example, those 500 largest US companies. If you were to buy an index fund that tracks the S&P 500, obviously the performance is going to be different in different years. Last year, the S&P 500 had almost a 30% return. This year in 2022, it's down about 5% on the year so far. Now, what that means though, if you're buying in, and the philosophy of passive investments is buying when the market's up and buying when it's down. And in the long term, historically, we've seen about an 8% plus return for you overall. So even if you're buying in years where the performance is up 30 or when it's down 30, in the long term, that's when you're going to see that good result.
Okay, so now let's get into how you're actually going to go about buying these passive investments. How are you going to buy them? What are your options? So step number one, really simple, is figuring out which investment platform you're going to use. That's step number one. Figure out which investment platform you're going to use. So you have a couple options. If you're going to go the do-it-yourself route, you can either use your bank's investment platform, so the bank that you use, or you can use an online discount brokerage. So that's kind of one option. The second option is using a robo-advisor. Now let's break down a couple things here. So if you're doing it yourself, what does that mean? That means that you're buying these passive investments consistently, so on a consistent basis, and you're the one who's actually going in, you're figuring out which investment to buy. So you're going into your investment platform and you're figuring out which investments to buy, how much of those investments, and you're kind of managing it all yourself, right? Now, from what we found, the banks usually charge higher fees. It's not always the case, but for the most part, the banks typically charge more money. So we've actually gone the route where we actually favor the online discount brokerages more. So for us, we actually use Wealthsimple Trade and Questrade here in Canada. And if you're in the US, M1 Finance is also a really great option as well. Once again, I'll link down below. And then there's robo-advisors. So these are also digital platforms that invest in passive investments. But one of the key differences here amongst robo-advisors versus, DIY investing, whatever, is that you don't actually have to go into the platform and buy anything yourself. The algorithm will just do it for you. Now, when it comes to fees, they are more cost effective than, active investments or active fund managers, but you are still paying a little bit higher than, let's say, doing it yourself, just because of the whole convenience thing. So once again, we use Wealthsimple Invest here in Canada. So now step number 2, once you're finished setting up a profile with any of those options that we just listed off, now you got to figure out which investment account you're actually going to buy those investments inside of or within. So remember, investments are anything from index funds, bonds, stocks, you name it, whatever, right? And then your investment account is going to be where you hold all of those investments. So think of it like this. Think of it like a wallet. In your wallet, your debit card, your credit card, your gift cards, anything else that's actually in there, those are going to be your investments. And then the wallet itself that holds all those cards, that's going to be your investment account. Now, when it comes to the accounts, there's a few different types, but at a high level, you have ones that have tax advantages and ones that don't, right? Right off the bat. Now, what's interesting is that you usually want to use the ones that have tax advantages first before you head to any other ones. So for example, ones that have tax-free investments, right? Where your money can grow tax-free and you don't get taxed on any of the profits that you gain. But once again, there's a limit on this, so you got to keep that in mind. So if you're in Canada, this means the tax-free savings account. And if you're in the US, this means the Roth IRA. Usually, once you max those accounts out first, then you can head to the ones that aren't taxable. And then you can use those ones. Okay, so now step number 3. So once your profile is made and you've got that cleared, you've got your account, you've chosen the account that you're gonna invest in, now you gotta buy those investments. So if you're going the robo-advisor route, all you have to do is just fund the account and they'll buy those investments for you. If you're going the DIY route, on the other hand, you actually have to be the one to go and first figure out which investments you're gonna buy. So whether that's the index fund, the stock, whatever, you name it, right? Figure that out. And then you have to go in onto the platform, search for that investment, figure out the quantity that you want to buy, figure out what kind of order it's going to be. So whether it's going to be a market order or a limit order, right? Figure out maybe the frequency of how often you want that investment bought. And then once you've got that done, voila, you're done. Your investment is now bought. And now step number 4, AKA the final step, is super simple. It's just sticking with it and being consistent. Our overall message here is that, you can change things up the more you learn. Like for example, maybe you're not as happy a couple years down the line with the original index funds that you initially bought. You can buy different ones, or you can, add different investments as you go along and as you learn more. Or for example, maybe it's a couple years down the line and you feel more confident switching platforms to a more lower cost platform, right? You can do that. The overall message, and I think what's really important to keep in mind here, is that you gotta stick with it and you gotta keep investing. That is hands down main point. Continue to invest and make sure your overall philosophy remains as consistent as possible. So, if your whole thing is passive investing for the long term, then make sure you're continuously investing in passive long-term investments, right? Be consistent, simple as that. Let's get it.
There are 2 last things that we also really want you to consider that we kind of left out of the step-by-step process, but they're important when you're actually getting started. So those are your risk levels when it comes to investing, and also how much money you should invest. Now, obviously we called this video your first $1,000 to be invested, but you might not have that much to start. You might have more. Let's talk about how you can figure out what you should be investing on a consistent basis. Keyword being consistent. So the way that we kind of go about it is setting up a budget. The first thing you need to account for is obviously your necessary expenses. So your rent, your groceries, the things that you're gonna need to spend on a monthly basis to just live your life. Then look at, after that's accounted for from your income, look at how much you could afford to invest on a frequent basis. Now, obviously there's some wants and inessential expenses in there too. So have an idea of what you want to keep spending on when it comes to that in your mind. It doesn't mean it's essential expenses and investing. Maybe it is for you. If this really is your goal right now, you want to maximize how much you can invest each month, but basically come up with that number that's realistic for you to invest every single month. Now, once you have that number in mind, an ideal thing to do would be to actually set up automatic payments to push that money into your investment account each month. Don't forget to actually buy your investments too. It's not like it's all done for you unless you have a robo-advisor, but at least doing that, you're not going to miss some months either. The other thing that you have to think about is your risk level when it comes to investing. Now, this topic could be a whole video on its own. We'll definitely touch on it more in the future. We've talked about it in the past, but there's a few high-level things for you here. If you're investing in something like a robo-advisor, they're gonna actually ask you a set amount of questions to kind of determine what your risk level is. So it's a little more straightforward there. Now, when it comes to you, if you're DIYing it, whatever index fund you choose, you're kind of going to be picking ones based on your risk level, right? So ones that have more stocks in it, more bonds, things that kind of hedge your risk. All of that you're going to have to consider for yourself too. Now, again, that's super high level. We'll talk about this more if you have questions or drop them in the comments for us. But the main thing to kind of keep in mind, the main rule of thumb, is if you're younger, you have more time to be risky. You have more time for if the market drops, for it to go back up again, and for you to get that high average return. If you're older, it means that you're maybe going to want to start to think about being a little less risky with your investments.
All right, guys, that's a wrap on this video. We hope that you enjoyed it. And yeah, we know that there's a ton of information in there, but we're trying to keep the key takeaways super, super simple. So first and foremost, make sure that you know that you can invest passively for the long term and for your future. Invest today, right? Like get started on that today. Ideally yesterday, but today's the next best day. So do that. Be consistent, right? If you want good long-term results, you have to be consistent. Now, we're gonna have a follow-up to this video, which is exciting. That's gonna be comparing ETFs to mutual funds and how index funds kind of fit into the whole mix. So make sure you're staying tuned for that. And yeah, as usual, make sure you like down below, make sure you subscribe right there in the corner. And if you haven't seen any of our previous videos, make sure you check them out next door. We will be back. You know the vibes. Let's go.